The Federal Reserve might cut interest rates in September 2024. This potential move has been the subject of much speculation and analysis among financial experts and economists. Many experts are predicting this move, citing various economic indicators and trends that suggest a rate cut could be imminent. The economy is showing signs of slowing down, with consumer spending decreasing and businesses facing challenges. This slowdown has raised concerns about a potential recession. The Fed wants to keep the economy growing and avoid a downturn. They are closely monitoring economic data and trends to make informed decisions. A rate cut could help boost the economy by making borrowing cheaper, encouraging spending and investment. This could provide much-needed relief to struggling businesses and consumers. The Fed has been raising rates to fight inflation, but with inflation cooling off, they now have more flexibility. Inflation has been cooling off in recent months, with prices for goods and services stabilizing. This trend is a positive sign for the economy. This gives the Fed room to start cutting rates, potentially as early as September. Lower rates could stimulate economic activity. Lower rates make it cheaper to borrow money, which can lead to increased loans for homes, cars, and businesses. This can lead to more spending and economic growth, helping to revitalize the economy and support job creation. Inflation is a major concern for the Fed. It affects everything from the cost of groceries to the price of housing. When inflation is high, it erodes purchasing power, making it harder for people to afford everyday essentials. When prices rise too quickly, it can hurt the economy. Families struggle to make ends meet, and businesses face higher costs, which can lead to layoffs and reduced investment. The Fed has been raising interest rates to try to bring inflation down. By making borrowing more expensive, they hope to slow down spending and investment, which can help reduce price pressures. These rate hikes seem to be working. Recent data shows that inflation is starting to ease and some prices are beginning to stabilize. The Consumer Price Index, or CPI, measures inflation. It tracks the prices of a basket of goods and services that households typically purchase. The CPI has been falling in recent months. This is a positive sign that the Fed's policies are having the desired effect. This suggests that inflation is starting to cool off. Lower inflation means that the cost of living is becoming more manageable for many people. The Fed wants to see inflation fall to around 2%. This is considered a healthy level of inflation that supports economic growth without causing too much strain on consumers. If inflation continues to decline, the Fed will be more likely to cut rates. Lower interest rates can help stimulate the economy by making borrowing cheaper, encouraging spending and investment. Federal Reserve Chairman Jerome Powell has hinted at a possible rate cut. Powell has said that the Fed is data-dependent. This means that the Fed will be closely watching economic data before making a decision. The Fed will be looking at inflation, unemployment, and other economic indicators. If the data shows that the economy is weakening, the Fed will be more likely to cut rates. However, if inflation remains high, the Fed may have to keep rates high as well. Section 4. Election Year Politics. In this segment, we delve into the intricate relationship between politics and economic policies during an election year. 2024 is an election year, a time when political strategies and economic decisions often intersect in significant ways. This could play a crucial role in the Federal Reserve's decision-making process as they navigate the complex landscape of economic stability and political pressures. Presidents typically want the economy to be strong during an election year, aiming to showcase their leadership and secure voter confidence. A rate cut could help boost the economy, potentially increasing consumer spending and helping the incumbent president's chances of re-election. However, the Federal Reserve is supposed to be independent, making decisions based on economic data rather than political influence. This means that it should not be influenced by politics, maintaining its credibility and the trust of the public. The Fed will likely try to avoid any appearance of political bias, striving to uphold its mandate of fostering economic stability and growth. They will base their decision on the economic data, carefully analyzing trends and indicators to determine the best course of action for the nation's financial health. Section 5. Market Impact and Outlook. The markets are expecting a rate cut in September. Stock prices have been rising in anticipation of a rate cut. Lower interest rates make stocks more attractive to investors. A rate cut could also lead to a weaker dollar. This would make U.S. exports more competitive. Overall, a rate cut would likely be positive for the markets. However, it is important to remember that the market can be unpredictable. Section 6. Timing is everything. The Fed faces a delicate balancing act. They want to support economic growth. They also need to keep inflation under control. The timing of a rate cut is crucial. If the Fed cuts rates too early, it could lead to higher inflation. If the Fed waits too long to cut rates, it could risk pushing the economy into a recession. The Fed will need to carefully weigh all of these factors before making a decision.